Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Spring Webinar Series. This program is entitled Coming to America, Immigration, Tax, and Estate Planning Considerations. For those who don't know me, my name is Jonathan Shenkman. I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You could read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. You can see all my work on my website at shenkmanwealth.com/articles or follow me on social media at Shenkman on Money. Additionally, I just launched my podcast, which is also called Shenkman on Money, and you can check that out at Apple Podcasts, Spotify, or wherever you get your podcasts. One more quick note before I introduce our esteemed panelists, and that is about the CPE and CLE credit for this program. If you are a Connecticut, New York, or New Jersey-based attorney or CPA, please pay close attention. I'll be giving a code during this program that you must write down, so please have a pen and paper ready. After the program, you'll receive an evaluation form where you will need to insert the code in order to receive credit. Now, with that introduction out of the way, I'd like to give a short bio for each of our three esteemed panelists. First, Michael Wilds is a managing partner with the leading immigration law firm Wilds & Weinberg, located in New York City, Miami, and New Jersey. He serves as counsel to Lincoln Center and several international corporate law firms. A former federal prosecutor with the United States Attorney's Office in Brooklyn, he has testified on Capitol Hill in connection with anti-terrorism legislation and is internationally renowned for his successful representation of distinguished individuals, including former First Lady Melania Trump and soccer legend star Pele. Larry Lipoff is director in CohnReznick's Trust and Estate Practice, based in the firm's New York office, with more than 30 years of experience specializing in the delivery of domestic and international private client services to enable high net worth individuals and families maximize their new or generational wealth. And finally, Eli Akhavan is a partner at Steptoe & Johnson, where he focuses on tax and estate planning for high net worth U.S. and non-U.S. clients. He advises domestic and international individuals and families with respect to tax and estate planning for their U.S. assets and beneficiaries. Eli also advises cross-border clients on all aspects of international estate matters, including foreign trust, pre-immigration and expatriation planning, and on planning for the purchase of U.S. residential and investment real property. Today, Michael, Larry, and Eli will be discussing Coming to America, pre-immigration tax and estate planning considerations. Now, before we launch into the meat of our program, I'd like to ask each speaker to spend just 30 seconds to tell us a bit more about their practice area in case I left anything out. So let's first go to Michael.
Thank you so much for hosting me, and I'm honored to be with these other distinguished panelists. The law firm Wilds & Weinberg that I manage was started by my father. He should live to 120. He's actually 90 years young. He started it in the same building where we're paying rent on 53rd and Madison in Midtown. All we do is U.S. immigration, New York, New Jersey, Miami, and by appointment only in Los Angeles and Tel Aviv. We have 5 divisions. We deal with business visas. I teach business immigration law at Cardozo Law School. We have a family unit. We litigate in federal court and in immigration court, trying to move our clients' matters forward if we need to. We have a robust consular practice and ultimately a onboarding and compliance, I-9s and all of that. We're generally the first lawyer that a foreign national meets, and before they even make a decision to take a green card, a visa, or citizenship, or to give it up for tax reasons, we're often the first lawyer, and we make a lot of referrals. So I'd love to hear from you if I could be of any support.
Great. And let's turn to Larry for just a 30-second overview.
Thank you very much. So, Jonathan mentioned that I'm at CohnReznick, part of the National Tax Department. One of the things is going on that I find pretty interesting is that as I get more years of experience, that seeing these specialization in accounting and legal practice as well, that it's good to be a generalist. So I was a tax generalist before I became a specialist, first in S corporations and then domestic and then international trust and estate work. And I find that being able to jump through and see things from a holistic viewpoint is very helpful as being part of a professional team, and especially for our mutual clients. And hopefully some of those issues will come to play in today's session, but also as matters come up going forward, if it could be helpful, very helpful, happy to do that. And having such a fantastic team of professionals, I appreciate being added to the program.
Great, thank you. And let's turn to Eli for a quick overview of his practice.
Good morning, everybody. Thank you for joining in today. Thank you to Jonathan for arranging all this and this terrific panel. I'm happy to be on with Larry and Michael. As Jonathan mentioned, I'm a partner in Steptoe and Johnson's tax and private client group practice. I focus on domestic and international estate planning. I'm involved in various both domestic as well as international bar associations that deal with cross-border issues. I've taught international taxation at St. John's University School of Law. This year in particular, I've had a lot of opportunity to travel abroad. And the trend that we're seeing is that people from abroad view the US as a safe haven. And even if they're not prepared to move themselves yet, they're certainly moving their assets. If they have adult children, they're encouraging them to move to the US. So you're going to find today's program quite informative to at least have the high level overview of the issues that you should advise your clients on.
Great, thank you so much, Eli. Now let's turn back to Michael, just to set the stage for us to first discuss the immigration planning process. My first question is basic, but of interest to many, and that is, how long does the immigration process typically take?
Well, thank you. And first, I didn't plug, when Eli said safe haven, I actually wrote a book and it's called Safe Haven in America. So it's available if I don't put you to sleep. How long does the process take, Jonathan? As long as you let it. We're experts in our office at speeding things up when they're going to slow and choosing options from the outset where timing becomes the most relevant feature. Many lawyers convince clients to apply for green cards right away, but that's often the wrong strategy and strips a client of control over the process. My dad trained me to give somebody a visa solution, but place them in a position where one day they may want to apply for a green card or retreat back, put them in a visa that allows for a dual intent, but don't necessarily go there without taking good tax counsel. To do the green card process properly through an embassy, it can easily, on timing, Jonathan, take about 2 years. Well, often we want to find a temporary solution to give a person the ability to enter, to start working, and then handle the green card on their timeline to limit the inconvenience. We've done cases with clients in the United States who later go get their green cards abroad. We've done domestic clients where clients travel from before we start until the case ends. And for clients with limited needs, the key is planning ahead to make sure that they have the right visa to start and the timing is lined up. When things go sideways and people come to us to complain that their case is taking forever with another lawyer, we then look for intermittent solutions, whether that's an H-1B, a professional work visa, the acronym HELLO, H-E-L-O, the H visa, the one that's a specialty occupation if you have a degree, gives you a proper installation. Investors, entrepreneurs, risk takers, those E-visas that have make America or founding documents and founding parents proud a generation later, or the intra-company transfer, the L visa, or for the rock stars, those O visas, people who are distinguished in their space. Sometimes we have to go not just for those lettered visa band-aids, but also emergency advance parole, travel permission, or mandamus lawsuits, go to federal court to bully the government into moving our clients to the front of the line.
A comment I've heard from clients is, I want to move to America, but my accountant told me to avoid a green card. You may have touched on this a bit, But for an individual like this, what are their options?
A lot of our clients come in and you can tell that they're allergic to a green card for tax purposes, and they're under different impressions what a green card, what citizenship. And there are a lot of people that have exposure or they're multinationals of several countries. You have to make sure that you see things in the room that your client may not anticipate. It's a common situation for our clients, and there are few key factors to consider, including current employment, their credentials, and planned activities in the United States. Is there a brief, innocent, and casual need to be in America? Is there a relative that they're seeing, and so forth? If a person will be running their own business, we generally want to do a top-down assessment to include the eligibility for those L1s, the E1s, the Os, those international entrepreneurs, visas, and other options. The L and the E are the nice visas because they give a long term on each visa. I've had oil magnates that have been in America on E2s for 30 years. We've had clients that they watch days so that they run a sconce of taxation and visas at the same time. The L and the E2 are nice because they give a longer term for each visa, meaning less trips to the embassy. There are reciprocal relationships that we have with particular countries, so it's nuanced by where the person is from. But the L1 is not a status that can be held indefinitely, and it requires the company to have operations, employees in both the United States and abroad, and that can potentially create business expense that's unnecessary. I like those visas, but I love the O visa because it's great for people who want to dabble in multiple businesses, working for different jobs. They can be their own gentleman, gentle lady if they want. It gives them flexibility to potentially renew indefinitely, but you have to have risen to a level of achievement in your space. One half measure that sometimes works for people who want to buy time in applying for a green card with USCIS, which is immigration, but not finishing the process as a Band-Aid is sometimes a way to have a cake and eat it too. You can also have couples, particularly where one party gets a green card and it includes children up to the age of 21, and then the principal person with wealth doesn't. We have a billionaire Canadian family with the entire family, literally about 30 people on E2 visas, dozens of people living full-time in the United States, minimizing the tax burden and doing everything properly according to immigration law, because there are many loopholes or nuances that we know how to work. We've also gotten other creative solutions where we use for clients, but a few key questions are usually enough to help point us in the right direction, and we have that capability of doing it in the initial intake.
Many of the attendees on this webinar are advisors to high net worth families living abroad, some of which are eager to move and work in the US. Can you tell us a bit about the EB-5 program, how it works, and any best practices for advisors to consider when speaking to their clients?
No problem. My father actually testified on Capitol Hill in support of the EB-5 program, and it is robust. We have, thank God, a stellar record in dealing with those cases. The EB-5 program is essentially a government-approved way of buying a green card. Technically speaking, it's an investment in the United States project, which means that the money can earn a return and be recouped at the end of the project. Investments aren't, there are three kinds of EB-5s. One, you put $1,050,000 into a business where you're paying 10 people to do work. That may be hard in this economy to sustain. The second one is if you're doing $800,000 in a rural area where unemployment is very high. Or third is a regional center, a matrix of about 875 companies that have been pre-approved, where you give them 800K and you get it back 6 years later. EB-5 investments tend to have a lower return and higher risk than other investments. Oftentimes, other investors are EB-5 investors, as most people just look for a return, seem to steer clear. And there are many anecdotes of investment schemes run by shady operators. If you Google it, you'll see it's very disturbing, and there are a lot of unethical practices historically in this space. There's a double whammy, because if the funds are stolen or the project doesn't go as planned, it could also mean that the investor doesn't qualify for the visa. You get a conditional green card only good for 2 years. You then have to file a petition to remove the conditions to the green card, much like in marriage cases, the government wants a look back. Knock on wood, to date, our EB-5 clients have not lost money and all have received their money back, going with reputable investment opportunities and professionals like you. I'm not licensed to tell them where to put their money, is substantial and critical to achieving a good outcome. The process to obtain the conditional green card is lengthy. It often takes 3 years. And for that reason, we have to look for another visa solution or put the party abroad. We have a lot of Russian and Chinese magnets where the principal doesn't go for tax reasons, but the spouse goes with the children up to the age of 21. Again, once successful, immigrants get a conditional 2-year green card. 90 days before the end of the 2-year period, you file another petition to remove the conditions, thus making them a full permanent resident. So you have to make sure you stay with a law firm that knows what they're doing. In every case, the EB-5 investors must be able to demonstrate a lawful source and a path of funds. These applications are, feet long, not inches long in our office. And often we do a deep dive for our client to make sure that it's sourced out properly and that they understand. The law lapsed last year, which is a ridiculous experience, where there were 50,000 people who had invested these substantial funds and their case was lost in the shuffle, which is a remarkable experience. So you have to be able to warn your clients and pivot if there are delays from COVID to even happenstance in Congress, who is a mess when it comes to these things, unfortunately.
Great. Thank you, Michael, for that helpful background and setting the stage for us. Before we continue with the estate and tax planning portion of this program, I'd like to first share the code for accountants and attorneys who are taking this program for credit. Please write this down. The code is E22. Again, E as in echo, the number 2, and once again, the number 2. One final time, E22. Okay, for this section, I'll direct each question to either Eli or Larry, but either of you can feel free to add to any point being made. For the first question, which is for Eli, what are the 2 primary tax goals that pre-immigration planning achieves?
So in order to answer that question, we have to understand the basic US tax system. In general, globally, there are 2 ways to tax individuals and companies as well. But one is, we're going to focus on individuals now. One is by residence, where an individual actually resides. And the second is through citizenship. And those taxation systems globally have either solely one way or a combination of the 2. But those are the 2 general ways. Now, citizenship taxation by citizenship means as long as you're the citizen of one country, that country gets to tax you on your worldwide income, no matter where you reside. Currently, there are only 2 jurisdictions on the planet that do that. One is the United States, and second, I wish we could get some sort of audible input from the audience. The second jurisdiction is Eritrea, and Eritrea it's not a made-up country. It's actually a country in Northeast Africa. I believe it's next to Ethiopia. It's by the Red Sea. Somebody really never mentioned, but that is certainly a interesting feature that the United States shares with another country in around the world. I don't think we share any other commonalities with them. But these are the 2 countries that tax by citizenship. Now, when an individual comes and wants to move to the United States, and whether they become a tax resident or eventually a citizen, the tax effects are generally the same. In 35 minutes or 36 minutes for me and Larry to speak about tax immigration strategies or pre-immigration strategies, we could speak a whole day on it. I'm sure Larry can as well. But we're going to give you the high level overview here. But there are 2 tax systems in the United States you got to be concerned about. 1, the income tax. 2, estate and gift taxation. So once an individual moves to the United States and becomes a tax resident, so if they're a green card holder, tax resident, they become a citizen, a tax resident. if they meet the substantial presence test, which is essentially 183 days within 1 year that they're in the US, or they meet over a 3-year period, 120 days each year being in the United States, that's what the formula comes out to, they become a tax resident. So if you become a tax resident of the United States, you're subject to worldwide taxation. So for people who already have gains in their home country, and those gains would be subject to high level of taxation in the United States, it may make sense for them to dispose of those assets and recognize those gains while they're still in their home country. Now, obviously, the tax rates make a difference. Investment horizons make a difference. Tax should not be driving all investment and asset allocation decisions, but that is certainly one item to consider. Second item, the United States treats ownership by tax residents of the US, but ownership of foreign entities in quite a negative way. So we have what are called the anti-deferral regime, and that includes CFCs, controlled foreign corporations, PFICs, passive foreign investment companies. So if you have a US resident, tax resident, that has ownership interests in foreign entities, you may not want them to own those foreign entities when they move to the US due to the adverse tax consequences. There are different ways you can liquidate the corporation, you can make a check the box election on those entities. There are a myriad of ways to address that, which again is beyond the scope of our talk today, but that's just some issue to be aware of beforehand. Another advantage of making a check the box election, which Larry may address, is getting a step up in basis. So when that individual does move to the United States, their basis in the asset may be higher. So when they do sell it, they'll have a much lower gain or a zero gain. Now the step up in the check the box election, which essentially treats an entity as a different type of entity, and it steps up the basis in the entity's assets, that may not cause a tax event in the individual's home country. So they get a tax benefit in the United States, no adverse tax on consequence in the individual's home country, win-win. Okay, those are some basics on the income tax strategies that are available. The next issue they have to be aware of is estate and gift taxation. So when an individual becomes a domiciliary of the United States, which means that they are present in the United States and they have no definite present intention to leave, they are domiciled in the United States, which means they're now subject to worldwide estate taxation on their assets. Now, why is that important? Well, worldwide estate taxation means that if they have assets in their home country and they wanted to move it around, they want to make gifts of it, the moment they become domiciled in the US, that's it, they're done. They're going to be subject to US estate taxation or gift taxation. Doesn't matter where they're making gifts, doesn't matter that their assets are cited abroad. The US will tax those assets for estate and gift tax purposes if they meet certain thresholds. So it may make sense that before they move here, and if they're way over the exemption amount, which is currently $12.9 million, they move around those assets, they make gifts of those assets. So if they're abroad, they're not a US domiciliary yet, they can make gifts of $50 million, $60 million, assuming there's no issue in their home country, with no US estate and gift tax consequences. And that may be a beneficial idea. But in general, those are the two regimes you got to be thinking about: one, income tax, and one, estate and gift tax. And I want to point out this nuance difference. Just because an individual is a resident for income tax purposes does not mean they're a resident for estate and gift tax, and vice versa. So what that could actually mean is that an individual moves here, they may not have been a tax resident for income tax purposes yet, they don't have a green card, they haven't met the substantial presence test yet, they're not a US citizen, but the moment they move here with no definite present intention to leave, they become a domiciliary for US and estate gift tax purposes, which means that the worldwide assets are now going to be subject to estate and gift taxation.
Eli, just a couple of thoughts. number one, it's great, the quadrant, because you could be, not resident for both income and gift and estate. It could be for both. It could be one and not the other. I've had every single quadrant. So that becomes really a good way to lay it out. And I think a lot of clients become surprised, which leads to an interesting quandrum, because sometimes if you have a non-resident alien who is US property, if they would figure out a way to become a US resident for estate tax purposes, so when they pass away, sometimes it comes out that they'll pay less United States estate tax as a United States resident than they would as a non-resident. For example, a United States resident, now they have almost a $13 million lifetime exclusion. If they're a non-resident alien, it's going to be $60,000. United States person, if they have debts, that's going to go against their worldwide assets. If there's going to be a non-resident alien, it's going to be a fraction, the deductibility, a fraction of their US assets compared to their worldwide assets, and they're looking at a $60,000 exclusion. So, and practically, and Eli, I'm sure you've had it also, where it's not clear if someone's a domiciliary or not. It could be on the gift tax side, and very much so on the an estate tax, and it becomes the finding of fact of what they actually are. The other point that I've had is that the check the box election in pre-immigration, which you mentioned, which I think is a powerful tool, especially if, let's say, someone has a fund or something like that, really appreciate assets, to check the box. But question becomes in the literature if that works, because does that really have US effect? I think a lot of us as practitioners say, hey, it does, but there are articles out there saying, well, why are you actually doing it? How does that do anything other than a tax play? But what I'd like to bring up as a response to that question that's brought up in the literature is that it encourages people to come to the United States. And for the right people, the United States has a legitimate reason to bring them in, and to allow them to make this check the box election, I think is a powerful tool, not just for them and their family, but also the United States, for the United States' goals.
The next question I have is directed to Eli, which I think he may have already covered some of this, but if there's anything you want to reemphasize, why is it important for tax purposes to plan prior to immigrating to the United States? If you want to add anything to that.
Right. So I think I did cover parts of that. The key takeaway here is if you have a client and they have substantial assets and ownership interests, you want to plan for the income tax. As I said, if there are foreign entities that they hold, there are two reasons why you want to plan for that. One, to get a step up in basis so that when they do move here, they'll be subject to lower U.S. income taxation, and that's subject to what Larry just mentioned, having a relevant effect. And that is a great point. It's a nuanced point. Larry and I have worked on those type of issues before. Becomes quite important in terms of the tax, and that's why the tax consequences. That's why you got to work with the right advisor on this. But that's one reason. Two, as I mentioned, if you have U.S. residents or tax residents that own ownership interests in foreign entities, you got to be careful there. So you got to be advised on what the consequence of that would be and how to plan for it beforehand. When it comes, and the takeaway for estate and gift taxation is that as long as you're not a U.S. resident, if you're making gifts of non-U.S. situs assets, you can put yourself in a better position when you do move to the U.S. And I wanted to point something out that Larry mentioned. There's a difference between U.S. situs and non-U.S. situs assets. So Larry pointed out correctly, if you have a non-citizen, non-resident that owns, let's say, U.S. real property, U.S. real property is going to be subject to U.S. estate taxation, even though that individual has nothing to do with the U.S., no residency, no beneficiaries, except for that ownership in that property. that property is a U.S. citus asset, and the non-citizen, non-resident is subject to state taxation on that asset. So there are what's considered a non-U.S. citus asset. Well, you have stocks, intangible property, tangible property that's located outside the U.S. Those are considered non-U.S. citus assets, and you can plan with those. But the takeaway is, client with substantial assets and even not so substantial, there's a lot of income tax benefits and estate and gift tax benefits that could be obtained prior to moving here. And you as advisors should certainly be aware of that and caution your client on it and advise and plan for them.
Let's return to Larry. How is a trust defined for United States tax purposes? What makes the trust domestic or foreign? And is the definition limited to an entity called a trust?
I really appreciate it. It's a fantastic question. And over my years doing this type of work, and I'm sure Eli's had it as well, has situations where something is called a trust. That's not a trust for United States tax purposes. Sometimes we've had other entities that are actually trusts for United States tax purposes. And to just give an example, and I think it's easier to back into the definition that way. So we had at my firm, a new client. They came in last year, the beginning of April of last year, and we're looking at that time, 2021 income tax compliance. And the person had set up in a foreign country, was a US person, that he was a potential beneficiary of a land trust. And the engagement partner, just brand new client, said, hey, I have this. Ooh, I have to speak to our international T&E group about it because we have this seemingly a grantor trust, for I could understand, it's a foreign grantor trust. And what are we going to do? Because if you have a foreign grantor trust with a US owner, the deadline is March 15th. And here the new client comes in the beginning of April 4th, 5th of last year. And it became a matter of concern until it reached me. And then I said, okay, if we have it, we have to worry about a form 3520-A. And whenever there's a 3520-A with the US owner, so the owner needs a 3520. So the trustee files a 3520-A. And here we go, and the individual has to file a form 3520. If it's late, there's a way to file a substitute 3520-A attached to the 3520. But you know what? Let me look at it. And the reality is that there's specific definition, but not totally clear in the Treasury regulations, not Internal Revenue Code. For those that want to write it down, it's Treasury Regulation 301.77-01-4. 301.7701-4. That's the definition of a foreign trust for United States tax purposes, which basically is a situation where there's someone, a trustee, that's managing assets for the benefit of beneficiaries. And it's not necessarily in business. That could be, it could say trust. Years back, I had a trust invested in from UK real estate hotel in Florida. And I said afterwards that, after I analyzed it, that this is really a partnership for income tax purposes. You have to be very careful. And sometimes, like in Canada, you could have an estate that's really a trust, or vice versa. So you have to look at that regulation. It's not that long, but you need to pass through it. Okay, so let's say it's a trust. Then you have to see, is it a domestic trust or a foreign trust? And what you're going to look at is that there are two tests. One is a court test, and the other one is a control test. And what I tell the people I work with and my clients, it's every trust is a foreign trust unless it meets the test of both the court and control test to be a domestic trust. So start off always with the understanding it's a foreign trust. So what is it? So court tests that the primary supervision is under a United States court. And the control test is that all that have the ability to make substantial decisions for the trust are U.S. persons, meaning citizens or resident aliens. If something goes wrong, there's a limited time to make a correction, to make it so that it's not a foreign trust. We often have situations in the last number of years that the concept in foreign jurisdictions of having a protector, which is not really a trustee, but whether or not fiduciary, not clear. But if you have a protector, sometimes that becomes a foreign person, and that could cause a trust to become a foreign trust unexpectedly. What could be a bad thing? Let's say a U.S. person sets up a foreign trust, has appreciated assets. They think they're setting up a domestic trust. It's actually a foreign trust. If there is appreciated income, there could be a capital gain transaction, an income tax recognition that one has to be very careful about and address it. So we need to be on top of that. Now, the next thing would be whether or not trust is a grantor trust or a non-grantor trust. So it's a foreign trust if it's set up by a U.S. person, general rules. So then if it's set up with a trust which has at least one beneficiary who's a U.S. person, and it's a foreign trust, that's a foreign grantor trust as to the settlor, the person who set it up. If it's going to be a foreign trust, if it's a revocable trust, so that's going to be a foreign grantor trust for U.S. purposes, going to have a non-resident, non-citizen as the grantor. If it's going to be irrevocable, an irrevocable trust can't make changes. So then what will be is it could still be a foreign grantor trust if the current beneficiaries can only be the settlor and or spouse. So you have to look at each situation and dig into the facts. I know, Eli, have you had situations that jumped out at you that, surprised everyone when you were brought into the situation?
So it's a good question, Larry. I think when it comes to cross-border planning, no two situations are alike. Generally, when it comes to domestic planning, we have a fair idea of the types of planning and the tools available at our disposal that we can do for the clients to achieve their succession and their inheritance and their tax objectives. When it comes to cross-border planning, it becomes a bit more complicated. So, I don't want to say every situation that's come to me has been a surprise, but they all have certain challenges that come with them. I think, one of the points you mentioned, and this is important to note for our clients, is that if there is a foreign trust, okay, so as Larry said, all trusts, first you got to classify the entity as whether or not it's a trust or it's not a trust. Now, assuming it's a trust and assuming it's foreign, and it's a non-grantor trust, so you got a bunch of hoops there. If you have U.S. beneficiaries of those trusts, you are facing a world of hurt in terms of what's called the throwback rules. And Larry may touch on a little bit on that, but you want to completely avoid the throwback rules because with respect to U.S. beneficiaries, because it could erode the trust principle, erode the trust value through penalties and all. And if you're asking me, Larry, what are the biggest surprises I've seen those where the client was not advised properly, or they were simply not aware of these situations, that they're going to have negative tax consequences. But those situations surprise me. And then we got to come in as advisor and be like, okay, how can we fix this and mitigate this as much as possible? That's one of the tax consequences. And then the other point you mentioned about the Form 3520s, there are severe penalties if there was a failure to file these informational returns. And there may be no tax due, but these are informational returns. And if you don't file them with the IRS on time, and Larry, I'm sure you can tell us a bit more about that. But if you don't file those, there are severe penalties that, again, will erode the trust value. And the onus is on the taxpayer to show, hey, this wasn't willful. These are the reasons why I didn't file it. And again, it puts the taxpayer or our clients in a more defensive position, which they don't want to be. But Larry, if you want to just hit on the basics of the throwback rules, I think that would be great.
Sure. So in terms of the throwback rules, if you have income in the trust, there is, in foreign trust, there is almost an expectation that the U.S. person is going to pick up that taxable income. However, that's not necessarily the case because the income from a trust goes to the beneficiary through a distribution. So let's say year 1, year 2, year 3, there's income there, and there's no distribution. In year 4, there is a distribution. So you have to use the government forms to figure out what type of tax would have been paid in all those years, and then you have to build in an interest charge. And what's considered income for domestic trusts, distributable net income is the term of, does not include capital gains for a domestic trust, but it does for a foreign trust. So you have to build that in as well. And then we're used to a distribution of capital gains or qualified dividends is going to be at a preferred income tax rate. Once you get into this, those preferred rates are gone. So I tell people it's the throwback rules, the sending out what was distributable net income to undistributed net income, UNI, is really a cousin of the CFC and PFIC rules that Eli had mentioned earlier. So you really have to build a structure. There have been thoughts about how to freeze the growth of a throwback. And sometimes the family dynamics, so you don't want to make a distribution, but there are ways to condense it so that almost like a blocker entity to control what's going on in the investments. But there's also what's called a default rule, which allows alternative to actual information, that by using a rolling average of 125% over a matter of years, one is often able to greatly mitigate the throwback rules. But the problem is you go into it once, the default rules, you're subject to the default rules for the rest of it, except the final year when it turns into the actual. The going back and obtaining information, because here it's a foreign trust, is very difficult, and it could be extremely complicated. Timing is usually, because accounting firms, law firms bill generally based on their time, it becomes a very expensive, tedious process, a lot of back and forth, and sometimes you just can't get the information. You have to make certain assumptions. And so I think that's an important point. One other thing that that Eli had mentioned with CFCs and PFICs, I could even throw in CFPs, controlled foreign partnerships, that if you have a foreign trust set up by non-US people, and the only beneficiary or some of the beneficiaries are U.S. persons, that through what's called the constructive attribution rules, there could be responsibility for this U.S. person who maybe never even knew that they were a beneficiary to be filing all types of informational findings. Sometimes there's requirements as deemed income. Also, foreign bank reporting, what's come known as FBARs. So there are constructive attribution rules with that as well. If someone has a signature or they're a beneficiary, so then it becomes pronounced. If there's more than one, there are other ways to offset and to analyze. But again, it's one thing after another of the complications that exist. And often you want to go to a skilled, experienced attorney like Eli to just work through all the ramifications, because the CPA may say, hey, I could tell you how one presumably needs to file, but how to go about it and to mitigate and just make decisions of what's going to be it. In my mind, it's more within the purview of a skilled international trust and states attorney than even at a CPA firm, as knowledgeable as we are, because you have to be sure that at a CPA firm, you're not practicing law.
Yeah, Eli, I don't know if we covered this in enough detail, but I just wanted to get back to the questions that I have. I have a trust or a civil law foundation that I set up before immigrating to the United States. What tax issues do I need to be worried about there?
Sure. So, and it's a great segue that I wanted to get into. Anyways, when it, you mentioned civil law foundation and trust, and Larry alluded to that as well. Many, the concept that there are two globally legal systems out there. One is this common law system, which the United States is under, many other countries are, and then there's the civil law. I don't want to present a law review article on this now, but just know that there's civil law and common law. Common law recognizes the concept of a trust, and civil law does not recognize the concept of a trust. The concept of a trust is essentially you're dividing legal ownership from beneficial ownership. That's the whole concept. You have the trustee. The trustee is under a mandate to provide, to manage the assets and distribute assets for the benefit of beneficiaries. So the trustee holds legal title, but is not to assets, but it's not necessarily the beneficial owner of the assets. Now, civil law countries include France, in the United States, Louisiana, which follows civil law because they were at one point founded by the French. They have a lot of these types of systems in place where they don't recognize necessarily the concept of a trust as we do, even though they're part of the United States. When you go globally or abroad, you'll see certain entities called foundations that are really as Larry mentioned, they need to be analyzed. What exactly are they? Are they a trust? Are they another type of entity for US tax purposes? You'll come across, and they're called foundations. Now, in the United States, when we think of a foundation, we think of a charitable entity, private foundation, a public foundation, but we're thinking of charitable vehicles for the benefit of not-for-profits. When we hear of a foundation from abroad, if you come across your practice of the word of an entity with the term foundation, does not necessarily mean that it's charitable. Sometimes it does, sometimes it doesn't. Examples include Liechtenstein Foundation. That's based in Liechtenstein, obviously. It's called a Stiftung. That's one type. There's a Dutch Stack Foundation, very interesting type of vehicle and entity. It's used for asset protection purposes. It's used for other purposes as well. In fact, if you Google it, you'll see that the Dutch Stack Foundation is the vehicle that's used to own a certain furniture company that we've all come to love and appreciate, even though we don't really like their instructions, and that's IKEA. IKEA's ownership structure is ultimately a stack foundation, and there are reasons why it was structured that way as well. So that's just a broad way of, to introduce the term foundation. There are Cayman foundations also, there's Panamanian foundations. Again, they're set up for different reasons. Now, Larry and I touched on this, but if, and this is a real takeaway that you have to appreciate, is that if they're going to be US beneficiaries of an entity that is considered a foreign trust or a non-grantor trust for US tax purposes, we're going to have problems. So if your client is in that situation, you need to plan for that beforehand. And there are ways to remedy the situation pre-immigration. So if you were paying attention, I had mentioned that pre-immigration, if your client has substantial assets, try to make as many gifts as you can to a trust, because if you make gifts to a trust, you're doing it outside the US tax system, so it's not subject to US and state gift tax, again, assuming it's non-US status assets. We don't usually like to make gifts directly to the beneficiaries because the grantor loses control. There are asset protection reasons in case they get sued, they're in a divorce, you don't want those assets in the beneficiaries' names. So we like to make them into a trust. But if you're making them to a trust and you're going to make them to a foreign trust, which is, again, either a civil law foundation or a common law trust elsewhere, either in the United States or somewhere else, the whole family's coming to the US, and all of a sudden you're going to have a foreign trust that could either be that could possibly be a foreign non-grantor trust, so you got to be careful, and you're going to have US beneficiaries. You may run into issues there. On top of that, there is also something called the 5-year rule when it comes to trust. So if you have a settlor, a foreign grantor, they make a gift to a trust, and they move to the United States, and it could be a U.S. trust, it doesn't matter, or a foreign trust, and they make a gift to that trust, and they come to the United States. The U.S. will say that trust, if that move happened within 5 years of the gift, that individual becomes a U.S. tax resident within 5 years of gift to the trust, that trust is a grantor trust. Now, I think Larry and I touched on it, but the difference between a grantor trust and a non-grantor trust, that's a tax concept, that's a tax idea. The tax idea is that the trust will be ignored for income tax purposes, and all items of income, deductions, expenses, whatever it is, flow through to the grantor of the trust, whoever the grantor of the trust is. So if a trust is classified as a grantor trust with respect to the grantor, then that trust is ignored for all purposes of the income tax, not a state and gift, but for all purposes of the income tax, and the grantor will have to pay the tax. So if you have a foreign grantor, makes a gift, I'll keep it simple, makes a gift to a trust here in the US, and they move to the US within the 5 years, that trust is now a grantor trust, and the grantor has to pick up all items of income. Now, they may be fine with that, but that's just something to consider. But if there are going to be US beneficiaries, you have to plan to make sure that those US beneficiaries are not hit with that terrible throwback tax that Larry went into. And I don't envy Larry when he has to make those computations and calculations of what those interest charges would be. And he said at some point you just have to make some assumptions there. But that's the real hard work there that needs to be done.
Maybe I could just dump on 2-3 things. I didn't know where time is coming down. But number one, I mentioned about the foreign foundations. Something that could be very helpful is that in the United States, a few states have started having foundations. Started with New Hampshire, pretty sure Wyoming, South Dakota. There may be 1 or 2 other states now. So any of us that represent, let's say, entertainers, big thing, often they have an entourage. Their cook, their this, that, the staff. So it may make sense to have a foundation a civil law-like foundation, one of these states, to own that entity that employs them. It could, any piercing corporate veil, all that could be a very good asset protection type structure for those types of clients. Another thing is we got involved in back when with different U.S. source assets and not. One thing that's mentioned was cash. Interestingly, that if a non-resident alien has a cash account, is it or not subject to United States estate tax? And the answer is it all depends. If it's at a commercial bank, it's not. But dangerously, if it's at an investment bank that's not a commercial bank, then it is. And I've seen a few times, and it's just like money in the same financial institution, and they put the cash account into the investment bank, and that became a very painful type of situation because it was locked, the account was locked until you could file a state tax return, and then receive a waiver, which even though the takes number of months to do the estate tax return, and then the government says 7 to 9 months on their website, but in the reality, it's like a year and a half, 2 years. So you get locked out. One last thing, pre-immigration, they come in and let's say it's subject to the throwback rules. Hey, this is a great way. I don't want to deal with throwback. I'm going to domesticate the trust. And now I should be able to, there's no throwback rules since like 1986 or something like that with domestic. And then I could make distributions. Great idea. The only thing is, back in 1991, Internal Revenue Service got wind of this and issued even revenue ruling of procedure 91-6 that said, no. You still have to be subject to filing and the throwback rules. And even worse with the throwback rules is that it just goes to the most recent years. So the older years keep on getting more and more, and the interest charges become worse. So in each case, Eli's been driving and drilling, and I think it's true. Anything foreign, inbound, outbound, you need skilled advisors. It doesn't have to be us, it could be others, but just have the right people involved and know what you do know and where you should really find other help if you're a professional to work with you on these cases.
We only have 1 minute left, and I just want to end on this last topic and then give everyone directions on how to get their credit. Eli, I know you do some work on expatriation. In 60 seconds, I know that's impossible to do because this be a whole topic for a whole day. Could you tell us a little bit about the expatriation process? High level overview, 60 seconds, go.
Sure. From that 60 seconds, let me just take 10 seconds to add one more point. Aside from skilled advisors here in the United States, make sure you are working in conjunction with your client's offshore advisor, wherever jurisdiction they're from, whether they're in Europe, Asia, any other country, Latin America, jurisdiction, Latin America. Make sure you have advisors there that work in tandem, because you don't want to mess up anything or cause bad tax consequences offshore. The exit tax and expatriation. If your client comes in, they move to the United States, I don't want to pick on any particular state, but let's say they move to North Dakota, and after a year, they see there's not much sunshine and they're not terribly happy there. They're like, I want out. What happens then? Well, you got to talk to Michael to see how you're going to get, abandon your green card or renounce your citizenship, whatever the case may be. But speak to Michael or any other advisor first. Second, you're going to be hit possibly with what's called the exit tax. The exit tax applies to what's called covered expatriates. Covered expatriates, you meet one of 3 tests. I'll go. The first 2 are it's either an asset test, 2 million above, or it's an income tax liability test. And if you meet any of those, and there's a third one regarding not having comply with U.S. tax rules, but if you meet any of those, you're a covered expatriate. And now, the day you leave the United States, your assets worldwide will get hit with a tax, even though you didn't dispose of them. So if client comes in after a few years, they're not happy in the United States, they want to bust out. Now you got to talk to the advisor about post-immigration planning and exit tax planning.
Great. Thank you so much. Perfect. That was a minute and a half, and that was pretty much most I could expect for such a detailed and complex topic. But thank you, Michael, Larry, and Eli for those thought-provoking remarks. I'll be sure to share all the speakers' contact information in the follow-up email of this program. And as I wrap up, I'd like to share some important information. First important item is to receive your credit for this program. Shortly after the conclusion of this program, you will receive an email from me with an evaluation form for the program. It will ask you to input the code that I mentioned earlier today, and you should put it into the evaluation form. After that form is submitted in the coming days, you'll receive an email with your certificate from ACE Seminars. Again, please keep an eye out from an email from ACE Seminars. If you don't see an email in the next few days with your certificate, be sure to check your spam folder. Again, the email with your certificate will not be from me, it will be from ACE Seminars. Second, my spring webinar series continues on Thursday, May 11th on U.S. beneficiaries of Canadian estates, U.S. tax issues applicable to inheriting shares of Canadian corporations, featuring Beatrice Davila and Sergey Todorenko, both tax advisors with Montreal-based accounting firm MNP. I'll send out an invitation to this and all of my upcoming webinars after the program. And third, if you or a colleague would like to be kept abreast of my latest articles, webinars, and all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. You could also follow me on Twitter, YouTube, and Instagram at Shenkman on Money, or check out my new podcast called Shenkman on Money, and you can subscribe wherever you get your podcasts. And with that, this concludes today's session. Please stay safe and healthy, and may the 4th be with you.